Bloomberg Audio Studios. Podcasts, radio, news.
Now, earnings season is in full swing, and election risks are rising as well. Let's get some market perspective from Ann Walsh. She is the Chief Investment Officer at Guggenheim Partners Investment Management. She joins us here on set. Ann, great to have you in the studio. Thanks so much for coming. Let me first ask you about, it seems like what Lee was telling us is that UPS, as a bellwether, the shipping volumes aren't as bad, right? It's a business, it's a margin problem that they're having. Having said that, I know you expect the economy to slow down. So what's your view on GDP and growth?
Well, thanks so much for having me here today. I'm so excited for the new format, so congratulations. It is interesting. We're a little bit more pessimistic, I guess would be the right word, with regard to where the economy is going. We think it's going to be a little bit slower than most of our peers in the industry believe. So looking for real GDP coming in second half of the year, moving into that 1.6 to say 1.89 level relative to about the 2% level that I think most of our peers are seeing and expecting. What we've really seen is a very bifurcated economy. There really are two economies in the U.S. right now. There's those with access to capital, those that are larger businesses, the wealth class, relative to the other part of the economy, which is small and mid-sized businesses, which make up 50% of the economy, and then also, income earners in the lower 50% bracket. And this is a very different economy between these two.
And so how does that bifurcated economy that you describe work its way into the markets? Of course, against that backdrop, we've spoken to a lot of investors who say quality, quality, quality. Does that hold in the fixed income market as well?
Absolutely. And in fact, I think that's the place to be. I mean, after all, when the Fed started raising rates, they put the income back in fixed income. And so as a result, higher credit quality fixed income in particular at this juncture is a really good place to hang out. You're getting well paid for being in the more conservative end of the fixed income markets, and with, little risk, I think, from spread widening. Fundamentals are very strong in corporate America, those that are in the capital markets, and even within high credit quality end of the high yield market, you can still get paid a very nice yield for not a lot of risk.
But what about the lower end? You see the leverage finance markets coming back. You see people coming to market with riskier deals, and the demand is insatiable. Do you think investors are ignoring a lot of the risk out there?
Well, again, in this bifurcated economy, those in the CCC rated category, for example, have probably the most risk. Profit margins, which is where we started, for example, with this conversation. I think that's going to be a problem potentially. Access to capital. We really don't talk a lot these days about the fact that the Fed's continuing its quantitative tightening. Liquidity has been very strong. Fiscal spending has been very strong. It's kept liquidity very high. As liquidity finally sort of recedes, as these long and variable lags take effect, that's going to be the part of the market that is the most susceptible.
And you said that the income is back in fixed income, and that's been true over the past several years. But when you think about a portfolio holistically, maybe the income is back, but is that sort of protection, that buffer, that diversification that bonds typically play in haven situations, is that back?
I believe it is. Frankly, the balance between the equity market relative to fixed income, I think that's an important place to be thinking about right now in this diversification. Equities have been very strong, obviously. The S&P 500 performance has been excellent, but it's also been highly concentrated. Lately, we've made a big deal in the markets with regard to the fact that there's been some broadening out, but there's still risk there. At the same risk that affects the CCC, particular part of the fixed income market, also affects the small and mid-sized businesses and that more broadened out market relative to the Magnificent Seven, for example. So I think that diversification benefit is definitely important, and that's why fixed income has an absolute role to play in a blended portfolio.
Well, double down there, because if the bigger companies, the large caps, have really been the comfortable place for so many investors to be. Does the fixed income story translate into the broadening? Do you buy that story for small and mid-sized companies, given the worries that some investors have about the profitability you're seeing there, the leverage, and the worry you've been mentioning about a slowing economy?
I think we have to realize something that's really happened differently in the U.S. capital markets over the last, say, decade, and that is the movement from a public market capital markets to a private market capital markets. And as a result, a lot of that risk has been shifted. Small and mid-sized borrowers are really reliant on banks, and banks are suffering more in this inverted yield curve environment and from this potential risk area from the very tight conditions that are existing with the Fed continuing to remain higher for longer.
Ann Walsh, CIO of Guggenheim Partners Investment Management. There are a lot of worries that if Trump were to take office, then there could be an inflationary force under the market. Do you share that view? Can yields actually be rising into next year, not falling?
So, if we just take one step back for a second and just think about the gravity of where we are in history, we are awash in what I would refer to as gray swans. We had former President Trump shot at in an assassination attempt. We've had the current leading contender for the Democrat Party, current President Biden, step back. This is an unprecedented time. And in an otherwise larger backdrop, if you will, of all sorts of other unprecedented economic milestones that we've seen, a huge amount of fiscal spending in a very low unemployment world, tightening by the Fed. All of this is going on, and now we have, of course, the volatility made worse by the question of policies. So to your question with regard to where we are in the risk of inflation, quite clearly the bond market thinks so, that there's a risk of inflation and these policies being inflationary because we've seen a bear steepener. And so as a result, I think the market is perceiving additional risks. I'm not entirely sure that I'm convinced that it's because of inflation fears. I think it's just because of the sheer amount of volume that we have to see get placed into the markets in the Treasury space. And what we're seeing is a bit of a sell-off in advance of expectations of more Treasury issuance. We'll keep on with the spigots are still on in Washington. We're still seeing fiscal spending, and that's still going to continue.
Kathy Jones of Charles Schwab made a great point on our weekend special because, to your point, there's been a lot of history happening. But on that weekend special, she said when it comes to politics, short term it doesn't matter, but long term it does. When you think about some of the potential policies that are being floated right now. And to that point, I'm wondering how you're thinking about it as an investor. We talk about the steepener, the flattener, some of these one-off moves that we're seeing. But long term, how are you thinking about actually putting this into a portfolio?
Well, so in what I call the intermediate term, I think that probably the more important information is still coming from inflation coming down and our expectation that it will continue to decline. And I think we're going to see the core PCE in line with expectations maybe coming in better, and by the end of this year, substantially better, relatively speaking, and a little better than our peers are expecting. And then at the same time, we see GDP slowing, we see unemployment rising a bit. So in the intermediate term, I think that Fed policy is really going to drive the markets, at least in the fixed income space, and obviously earnings and the potential slowdown in the S&P 500 and the equity markets. Moving forward beyond that, I think the number one thing I'm looking at is tax policy. And if Trump were to win again, I think we'd see deregulation again as part of an impetus there. But as far as international foreign policy, obviously tariffs, I think that will have a moving effect on the markets as well. But I think taxes and deregulation on the one side, I think both parties are going to continue to spend.
Yes.
And we're going to continue to see fiscal spending, and that's going to continue to have an impact on how much Treasury issuance we're going to see.
Does that, I've been doing this job at Bloomberg here for 25 years, and every few years somebody freaks out about the deficit and the national debt, right? It's massive, I realize, and we're making interest payments now of more than $100 billion a month. We're spending far more on our debt than we do on our military at this point. However, no one seems to care. I mean, we talked to...
Steve Eisman does not
Steve
care.
Eisman doesn't care. I talked to Ed Hyman. He doesn't really care. I mean, not because he doesn't care, but because the Treasury market's not freaking out. The dollar is still strong. Does it matter?
It matters. I think, however, the markets have digested it as a news element and as part of the backdrop. And so far, the sustainability of the debt payments hasn't been called into question. We've had a few bobbles with regard to rating agencies and the like, but the truth is that as long as the markets appear to feel that it's stable, then this becomes a non-event. And that's why these other participants are saying, yeah, don't worry, nothing to see here, don't look.
Even Gary Shilling doesn't care.
Well, listen, though, at one point, though, you mentioned the spigot still on in the Treasury market. People are soaking up the issuance so far. It's been on the shorter end of the curve for the most part here. At what point does that spigot start to close, or at least start to move towards being more closed?
Well, I think one of the other false narratives has been that our international friends have stopped buying our treasuries. That's not true. They are still buying. And as long as there remains an appetite for treasuries, and as long as the U.S. dollar is the reserve currency, then it appears that we get to that world of what I call stability. It's not optimal, but it's stable. And so for the time being, as long as that's the backdrop, I don't see a whole lot of change.
And I do want to talk about a little bit more in your CIO role. We're talking about Treasury issuance. Of course, a lot of issuance at the short end of the curve. That's been met by very, very robust demand, if you want to call it that. $6 trillion in money market funds. How are you thinking about cash right now, especially with yields at 5% and change?
Well, I think that cash is very attractive for many investors. There's still $6 trillion sitting on the sidelines, ready to be redeployed into some other part of the market when the opportunity is right. But at 5%-ish, it's very attractive to sit there with no risk and yet get that kind of return. And if you compare that to pre-COVID and the years post-financial crisis, that's extremely attractive relative to history.
And of those gray swans that you started off talking about today, which are you most concerned about?
I'm concerned about the fact that we have a unique set of dynamics that are going on in the economy right now that we're not accustomed to seeing. Normally, with this timeline, we'd have seen the Fed's actions really slow down the economy. We'd see unemployment rising. We definitely have already seen the kind of economy reaction that we would have otherwise. But because of fiscal spending, because of these strange cross currents that we're getting, it's creating a level of volatility that's almost unprecedented, particularly in fixed income markets. And relative to the VIX, for example, which has been, for the most part, pretty benign. And I think it's this uncertainty that is relative to history. As investors, we tend to look for patterns. And what we're seeing this time around is very few of the same patterns. And it makes it very challenging to look forward and prognosticate what's going to happen. As we like to say, it makes that crystal ball very cloudy. And I think that's one of the most challenging things about being an investor right now is the lack of paradigm or pattern that we're used to seeing.
And really enjoyed this conversation. Great to have you on set and spend so much time with us. Our thanks, of course, to Ann Walsh. She is Guggenheim Partners Investment Management CIO.